You are a real estate investor or wholesaler. You are looking to find real estate deals that require just a little bit of money out of your own pocket. You want to use other people's money. You want to get a loan, but you don't want a loan from the bank. Right? That's a process. That is a pain in the butt. So you decide to use creative finance. You decide to do subject to or seller finance to get real estate deals that require little to no money out of your pocket. And you found a property, but how do you know if it's a good deal? In this video, I'm going to explain to you how I analyze real estate investments using one simple rule, the 5-10-12. The 5-10-12 rule. I created the 5-10-12 rule so that in just seconds, you can analyze any creative finance real estate investment. You ready? Here's how you do it. 5, the property needs to have an interest rate under 5%. 10, the property, all in, cash out of pocket, under 10%. 12, the property needs to have a cash on cash return above 12%. That's it. That's all you need to know. That is how you analyze a real estate investment. It is that easy. Wait, are you a little bit confused? Don't worry, in this video, I'm gonna walk you through the 5-10-12 rule. I'm gonna give you some examples. I'm gonna put it to practice and explain every little detail so that you can use the rule in your real estate investing journey. Let me first start off by saying, how did I come up with the 5-10-12 rule, right? Why should you listen to me? Why should you trust this rule? Well, the thing is that I watched every single one of Pace Morby's video, every single one, and I took all of his criteria and condensed it into a simple rule. If a property passes the 5-10-12 rule, professional, expert real estate investors like Pace Morby himself will want that deal. And if they want that deal, you should want it too, and you should know that it is a good deal. Let's start off with the first part. 5. The 5 in the 5-10-12 rule. 5 means that you want the interest rate to be below 5%. This is either for subject to or seller finance. It doesn't matter. You want your interest rate to be below 5%. You're looking for an interest rate probably in the 2s, the 3s, or the 4s. That means that it is a relatively low interest rate and you know you're off to a good start. If a property has an interest rate of 6, 7, 8, 9, 10%, it's probably not a good deal. It's probably not going to pencil. So look for properties with rates under 5%. If you're doing subject to, if you are taking over an existing mortgage, make sure that mortgage has a low interest rate. 2, 3, 4. If you are doing seller finance, you are letting the seller finance you the property. You are letting the seller be the bank and you are going to be the lendee from the seller. Ask the seller for a rate below 5%. Try to get a rate. Principal only, 0% interest. If they say no, okay, go 1%, 2%, 3%, 4%, but try not to go over 5%. It's that simple. 5, make sure the interest rate is below 5%. That is step 1 of the 5-10-12 rule. By the way, if you're liking this video, make sure to subscribe. Hit that subscribe button right now. I drank way too much coffee. Step 2, make sure your cash out of pocket is below 10%. So if you are looking at $1 million home, it is $1 million home. Make sure that your cash out of pocket is less than $100,000. I'm not just talking about the down payment. If your down payment is $100,000 on $1 million home, your cash out of pocket is going to be over 10%. Why? Because you have other fees. You have agent fees. You probably have assignment fees. You have closing costs. You may have rehab costs. You have a ton of other costs associated with buying a property. Whether you're buying a property on market with a real estate agent or off market from a wholesaler, there are fees involved. So whether you're wholesaling a deal, whether you're investing in a deal for yourself, try to make the cash out of your pocket or your buyer's pocket under 10%. So the down payment probably needs to be under 5% to make those numbers pencil. That is how that works. All your fees, all the costs need to be under 10%. So that $1 million property, let's say we're doing a seller finance deal. You're going to want to give that seller maybe $30,000. 3% down. Then maybe there's $20,000 in rehab, and maybe there's $5,000 in closing costs. We're at $55,000. Then maybe there's $25,000 in agent fees. Now we're at $80,000. And then there's a couple other fees. You're at $90,000. That's 9% down. That's 9% down. Try not to go higher than that. Does that make sense? I hope that was clear. So the second part of the 5, 10, 12 rule is 10, meaning that your all-in costs, your cash out of your pocket, needs to be under 10%. Now let's look at the third and final part. Yes, this rule is so simple. That's what I love about this rule. That's why I created this rule, because it is something super simple for you just to be like, oh, 5, 10, 12. Does it fit those numbers? Yeah, it does. Okay, great. So the 12 part of this equation, the cash on cash return, and I'll explain what that is in a second, needs to be over 12%. For 5 and 10, we're looking at under. For 12, we're looking at over 12%. Your returns should be over 12%. And I'm not talking cap rate or return on equity. No, none of that garbage. The most important return in real estate investing, cash on cash return. What amount of money are you going to get back from the property in return for putting your cash into the property? That is the most fundamentally important number in real estate, the cash on cash return. So how do you calculate it? Well, let's just use that $1 million property again. We have a $1 million property. We put $100,000 down. We put 10% down, not down payment, all of our fees, agent fees, closing costs, assignment fees, rehab. We have $100,000 into this property. This property makes $1,000 in cash flow every single month. Cash flow after all expenses. I'll get into that in a second, but we're talking pure net operating income, cash flow. This property makes $1,000 per month. Times that by 12, that's $12,000. That means you have a cash on cash return of 12%. Ding, 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 that passes the rule, 12% or higher. Now, if the property made $2,000 per month in cash flow, you'd have a 24% cash on cash return. So you want the properties that you invest in to return 12% of the cash that you put into them. Does that make sense? Now, if a property passes the 5% rule, let's say it has an interest rate of 3%, check. If it has an all-in cost of only 8%, check. This is great, right? But the return is, let's just say, 6%. Do you throw this deal out the window? Do you say, that's a bad deal? No, not necessarily. This is a rule of thumb. This is a guide. This is just a guide. If a property only has 6% cash on cash returns, it depends where it is. It depends on many, many factors. You'll learn all this if you don't already know it the more you analyze deals. But just for a quick example, California, where investors invest not for returns, but for appreciation. They don't really care for cash flow or cash on cash returns. They care about appreciation. It's going to have a lot lower cash on cash returns, if at all. It may lose money. But if you go to somewhere in the country, let's say Mississippi, you're going to want your 12% cash on cash returns because you're not getting that same appreciation. So it's not so black and white. There's a lot of gray area involved, especially when it comes to the 12% plus cash on cash return. In my opinion, you need an interest rate under 5%. That's black and white. Like, you just got to get that. You need to put less than 10% down. Yeah, if it's 12 or 15, does that end the world? No, it's not to end the world. But that's what you should be going for. I mean, that's your hard-earned cash. That extra cash you're putting into that property, that's cash you can't put into another investment. So come on, try to keep as much cash as possible. Even if that means paying more for the property, pay more for the property over time. But keep your cash now. Your cash is your most important asset alongside your time. I think cash is better than time. So don't just go pissing away your cash, putting all your cash into one property. Sorry, that was just a quick rant. That one's pretty black and white. But the 12% returns, that's a little bit in the gray area. It is a great guide to shoot for. Now. Let's take a step back. I just went on a huge rant. let's take a quick step back. How do you determine 12% returns? Well, I explained how the math works, but if you're talking about cash flow, you better include all your expenses. So we know with real estate you have principal and interest. That's your mortgage, or whatever you're paying to the seller with seller finance, whatever you're paying for subject to their mortgage company, principal and interest. But you also have taxes. In Texas, where I live, taxes are more expensive than the principal and the interest. It's ridiculous. And you also have insurance, your PITI. Is that it? Does your property now cash flow if the rent or whatever is higher than the PITI? Absolutely not. Include the other expenses. What about your HOA? What about your maintenance and capital expenditures? You need to be putting a few $100s per month away for maintenance and capital expenditures. And that depends. If it's a small property, less. If it's a big expensive property, more. What about management? What about utilities? What about vacancy? You need to include all that into your numbers and then see if the property cash flows. And then if it has higher than 12% cash on cash returns, holy, you are finding an amazing deal. I'm not your financial advisor. I'm not your real estate agent unless you want me to be and you are in Texas. But go buy that property, not financial advice, because that's a great investment. If a property passes the 5, 10, 12 rule, and it really passes them, you are being conservative with your numbers and you are running them appropriately, you have found yourself a great real estate investment. You will be able to wholesale that property for a good chunk of change, or you'll be able to buy that property and retire early. I hope this video helped you. Please let me know in the comments if you enjoy these types of videos. I created this rule to help you. It helps me. Hopefully that helps you. I appreciate your time, and I'll see you in the next video. Thank you.